Hello, welcome to Any Answers Answered for March 2023. As ever, Tim and I have had a look through the pages of Any Answers and picked two, I think this time incredibly relevant questions for the time of year and the changes going on in the world of tax. The first, Tim, comes from Anon Ac, so I'm going to decide that's anonymous accountant. And the question is about the change of basis period. Now, I'm going to put to one side the fact that they talk about preparing for MTD. Bit confused, says the anonymous accountant, as to whether a change in the basis period now, so 23 rather than 23-24, is the better one to go for. Presumably the 18-month and commercial reason constraints would apply. I'm sure Tim will talk about that point. We would only choose to do this for businesses who would benefit from the overlap relief now. Anyone who would effectively bring a tax bill forwards, we would leave till 23-24. But saving tax isn't a commercial reason. So what are the satisfactory commercial reasons? I don't want to steal your thunder, Tim, but I think we'll conclude that we don't need a commercial reason in this situation.
Well, it all depends. And that, of course, is the better answer to any tax question. Here, it all depends on when you actually change the accounting date. And in order to answer the questioner as usefully as possible, I've actually run some figures through my change of accounting date software. And it's very interesting. Let me give you a very simple example, Giles. Suppose you've got a sole trader with a 30th of April year end, and they're making profits of 30,000 a year. And we're assuming that that's a consistent level of profit. Of course, in practice, it could go up and down, particularly with the pandemic and now coming out of it. With the 30th of April year end, you'll have 11 months of overlap relief. And I'm going to put in 44,000 as the overlap relief. So that was generated when profits were a little bit higher for some reason. If we do nothing in terms of change of accounting date, then the basis period will change to 5th April 24 anyway. And what is interesting with that level of overlap relief is that the profits will be roughly 30,000 a year for each tax year, except for the transitional year 23-4, when the profits will drop to 14,000. So for next year, if we don't change accounting date now, the profits will enjoy a significant reduction to just 14,000 for the tax year 23-4 because of the use of overlap relief. In this example, we have high overlap relief. But if I were to change accounting date now, in other words, to 5th April 23, then what happens is that that reduction to a one-off figure of about 14,000 happens a year earlier. It'll happen for the current tax year, 22-3. And that could be of significant cash flow advantage. So whereas many are saying, don't change accounting date to 31st of March or 5th April until next year, 2024, in some cases, it will be significantly beneficial, in this case, reducing this year's taxable profit by about £16,000 to change to 5th April 23. And that then moves us to the question which concerns the current change of accounting date rules, which will only persist until 5th April 23. And yes, there are conditions attached. You can only have a valid change of accounting date as long as you haven't changed it within the previous 5 years. However, even if you had changed to 30th of April 2 or 3 years ago, I would argue that changing to 5th April 23 is going to be for a good commercial reason. It's to tidy everything up in advance of this change of basis period. And I think it highly unlikely that HMRC would challenge that. So even if you have changed within the last 5 years, I would still recommend changing in the circumstances of those figures that I've given you. If the overlap relief was a lot lower, then I wouldn't. But yes, in many cases, worth changing to 5th April 23 rather than wait to 5th April 24.
An excellent answer. And of course, one of the other complexities to think about is partnerships. If you have a partnership, we can't just do this calculation and work it out for one of the partners. We have to go through the process for each of them to decide the best decision, and then they have to fight it out amongst themselves, I suppose. Having dealt with one of the two big topics of conversation at the moment, basis period, we move on to the other, which is corporation tax. And we have a question from the rather wonderfully named South Bank Delboy, who asked the question, looking for clarity on the corporation tax changes for investment companies, Tim. And they say, I'm looking for clarity. What will the CT rate be for April for small companies owned by 5 or fewer participators, so a closed company, holding a handful of properties that are let out and have profits under £50,000? Is it 19? Is it 25? With no marginal relief. I read on the Revenue's website, says South Bank Delboy, in line with the approach taken for the former rules, the small profit rate will not apply to close investment holding companies. The definition of a close investment holding company will follow the definition previously found at section 34. The question really here, Tim, is there a distinction between investment companies and property companies?
And the questioner says at the end, would be grateful for clarity on this. And the simple answer to his question is yes. To your question, slightly different. We need to go back, I think, to 2015, when we had the old small profits rate and the associated company rules and so on. The legislation has effectively been restored in every respect to that position. And that means that where a company has profit below 50,000, the corporation tax rate will continue to be 19%. However, in identifying whether that small profits rate applies, we need to look at a number of factors. One is whether there are associated companies, and that's a different question. But another is whether the company is a close investment holding company. And the small profits rate didn't apply back in 2015 to CIHCs, close investment holding companies, the definition of which would include a property company unless the tenants from the property letting are themselves unconnected third parties. In other words, if you've got a landlord who has incorporated their property letting business, provided that the properties are not let to connected third parties, and that could include other companies controlled by the same individual, but provided they're not let to connected third parties, the small profits rate will indeed apply, and the company won't count as a CIHC.
But of course, if it was a company within a group, which was just renting out to other group members, for example, that then would cause a problem.
And that would mean 25% on all of the profits of that property company in the group.
Two massive changes. And I know I keep going on about this, but I make no apology for it. Corporation tax hasn't gone up since 1970. A change of basis period for income tax is a once in a generation thing, if not even longer. We have to make sure we're on top of this. We have to make sure what we're doing is correct, and therefore, hopefully, a very valuable session. We look forward to seeing you on next month's Any Answers Answered, but until then, bye-bye.